Good morning, friend. Today, nice topic. Below, I have put together a complete, ready to use package for sharp ratio call spread. Options trading, step by step process in USA. A practical mock trade with numbers, a narration, voice-over script you can record directly, and 3 growth stocks under $20. Current price checks and whether price is below analyst consensus. Quick summary, 2 line. A sharp ratio call spread is an income oriented bearish to neutral to midly to bullish option structure that sells more short calls than long calls, ratio then limits upside risk by buying further OTM calls. A spread. The goal is to collect premium while controlling maximum loss and targeting a small repeatable profit. Strategy explanation, plain. You sell N short calls at a nearer strike and buy M long calls at a higher strike price, where M commonly a 2:1 ratio or 3:2 ratio. The short calls generate premium income. The long calls cap the unlimited upside risk that plain uncovered naked short calls would have. Net results. You receive initially credit, ideally the trade profits if the stock stays below or slightly above the short strike at expiration of its time decay, and implied volatility move favorably. When to use market view best when you expect neutral to slight bearish short term direction or modest upside but limited. Works well implied volatility. Fourth is rich enough to sell premium and you want to manage gamma and upside risk. Not suitable when you expect a strong rally unless long calls are seized to cover. Step by step trading process. USA brokerage ready. Choose underlining and time frame. Pick liquid underlining option open market interest and volume. Typical horizon 30 to 90 days. For crypto options, pick listed products with regulated options or use derivatives from uncentralized exchanges. Be mindful of different settlement rules. Decide ratio strikes. Common starting point, sell 2 calls shorter at a nearer OTM strike, buy 1 call long at a higher strike 2:1. Alternatively 3:2 etc. Example, underlining at $100, sell 2 into 105 calls, buy 1 into 115 calls. Check net credit and margin. Ensure the trade gives net credit or minimal debit and that margin requirements are acceptable. Record maximum possible loss. See marked numbers below. Position seizing and risk controls. Risk no more than 1 to 3% of account on a single trade for ratio spreads. Calculate worst case loss scenario. E.g. if price finishes for above long strike, use position limits. Execute or multi-leg order. Use multi-leg order type combo vertical to reduce the field slippage and ensure leg executions. If your broker does not support the desired ratio, leg automatically enter as a single combo or use limit orders. Define profit and loss rules. Exit rules. Buy back spread if profit reaches easy 30 to 40% of maximum theoretically profit, or cut loss at easy 50 to 70% of maximum loss. Consider rolling if outlook unchanged. Manage through expiration. Monitor risk near expiration. If underlining is near short strike, have plan to roll short calls up, roll out in time, or buy back to avoid assignment. In equities, taxes and settlement. For USA equities, options settled through broker ordinary capital gains rules. Check short term versus long term. Options are typically short term. For crypto derivatives, tax treatment differs widely. Consult tax professionally. Now, mark example trade. Members 2:1 ratio practical. Underlying XYZ. Currently $100 expiration 45 days out. Structure sell 2 into 105. 105 calls by 1 into 115 call. 2:1 short ratio spread. Example option premium mid price example. Sell 2 into 105 call at the rate of $3.50 equal plus $700 credit. 2 into $350 by 1 into 115 call at the rate price of $1.75 equal minus $175 debit. Net initially credit $525, that is $5.25 per spread unit, but per underlying share basis. Treat carefully P and L scenarios or expiration. If underlining 405, all calls expire worthless, you keep $525 maximum immediately profit premium collected. In underlining 105, all calls expire worthless, you keep $525 maximum immediately profit equal premium collected. If underlining between 105 and 115, short calls in the money ITM, some losses offset by long call P and L will decline as price approaches long strike. Worst at some point, but still possible positive depending on ratio and strikes. If underlining 115, maximum theoretically loss occur, calculate worst case. Short obligation 2 into stock price minus 105, long offset 1 into short price minus 115. Net payoff from options 2 into S minus 105. S 115 equal S minus 25. Net trade P and L equal credit net payoff 525 minus S minus 25, 100 into if measured in dollars, multiply by 100 shares. Solve for S where P and L negative and find maximum US calculator for exact numbers before trading. Important, this mock is illustrative, computing exact dollar exposures and margin with your broker. Risk control edge cases assignment risk because your next short calls early assignment on American options is possible before expiry, especially around dividends. Keep cash or long stock ready or buy back early. Fourth spikes is sudden fourth increase can guide and short call value. Consider buying additional protection or close and rolls. Liquidity and slippage ratio legs can be hard to fill. Use limit orders and check bid or spread. Crypto options differences. Many crypto options are cash settled, trade on different exchanges and have differing margin rules confirmed with the exchange. Voiceover script, direct step by step, readable lines. Use 60 to 90 seconds for the overview. 1. Number lines for recording. Hi, today we will build a short ratio call spread, a conservative premium selling strategy that caps upside risk. Step 1. Pick a liquid underlining and pick an options expiration 30 to 90 days out. Step 2. Choose your ratio. A common starting size is 2 short calls and 1 long call, a 2:1%. 2:1 ratio. Step 3. Set strikes. Sell nearest the money calls to collect premium and buy a further OTM call to cap larger upside. Step 4. Check the net rate. You want to collect premium but also ensure margin and worst case loss are acceptable. Step 5. Place the trade as a single multi-leg order to reduce fill risk. Step 6. Manage the trade. Set a profit to take, for example, 30 to 40, 50% of credit and a stop loss. Stop loss. Be ready to roll or close if the underlying approaches this short strike. Step 7. Watch for assignment. On American style options are dividend. Dates close or hedge yearly if needed. Final tip. Never risk more than you can offer to lose. Treat short ratio spreads like any options trade. Size small, manage risk and use clear exit rules. That's it. Short ratio spread can produce steady income with controlled upside risk when used carefully. Trade safe. And 3. Growth stocks. Use under $20 current price snapshot and short notes. I checked recently market write-ups quote pages November 26 to 28 2025 snapshot. Below are 3 growth oriented US equities trading under $20 at those checks. I including the approximately price data stamped a short growth thesis and whether the present prices is below a commonly reported analyst consensus 1-year price target. I used published analyst targets. Consensus or noted when none were available. Clean Spark Inc. Price $15.10 November 28, 2025. Short description. Clean Spark builds, operates energy infrastructure and Bitcoin. AI data centers revenue growth has accelerating as the company expands data center capacity and high performance computing offerings. Growth drivers. AI data centers demand energy services contracts and recurring hosting revenue present versus analyst consensus. Insider write-ups mention JP Morgan's coverage and listed price snapshots. A JP Morgan references in the right step noted on overweight with a $14 price target inside monkey summary, which implies the current market price $15 is slightly above that particularly target in short price target, but that Sources inside monkeys.com. One company is firm. Price $15.8 to $16.5. November 26 to 28, 2025. Short description: Fermi is a large-scale data center replay focused on AI hyperscale composes big power projects. Growth thesis: new campus developments, long-term power contracts, and high demand for AI compute capacity could lift cash flows as facilities come online. Present versus analyst consensus. Insider Monkey reports a consensus first year median price target $32 or 33, and individual target as high as 37 from some analysts, which means present price $15 to $16 is well below those analyst targets, that is market price. Consensus target that would indicate a potential implied upside versus analyst estimates. Quantum Computing Inc. Price $11.7, November 28, 2025. Short description: integrated photonics quantum system companies showing rapid revenue growth from commercialization of quantum and photonics products. Growth comes from product adoption in government and commercial R&D and expanding revenue base. Recent filling shows strong year-over-year revenue growth. Present versus analyst consensus. I found no widely published consensus for analyst 1 year price target for QUBT in the sources. Checked ins. I cannot confidently state on n. I now analyst target comparison for qubit. You should check your broker or a dedicated analyst page for current target. Fermi Inc. FRIMI. We used the $16 price from earlier and built a concrete mark short ratio call spread, so you get a full P&L table. Break-even profit if expires worthless example losses at key prices and notes about risk. I use realistic illustrative option premium assumptions. Replace with live quotes from your broker before trading. Assumption: mark trade underlining Fermi FRMI current price is at $16. Expiration 45 days out. Example: structure 2:1 short ratio, sell 2 into 17.50, calls buy 1:22.50 call. Option premium mid prices assumed. Sell 17.50, calls at the rate of $1.20 each by 22.50, call at the price $0.60. Position size: the contract said about 2 short calls, 1 long call, and value shows in USD initial cash flow. Trade from selling 2 calls, 2 into $1.20 into 100, that meaning equal $240. Debit for buying 1 call equal 1 into $0.60 into 100, that is minus $60. Net initial credit $180. You receive $180 now. P&L summary for the position above dollars. Maximum immediately profit if underlining 17.50 at expiry. 180. Keep the credit. Break even at expiration $18.40 per share. derived K1 plus credit 200 equals 17% 50 plus 180 obligation 200 equal 18.40. Maximum theoretical loss unlimited. This 2:1 ratio leaves net short exposure losses grow as price rises above the long strike. Important, unlike some vertical spreads, a short ratio with more short calls than longs is not fully capped. It exposes you to large upside losses if the stock shows P and L table selected underlining prices at the expiration. Underlining to expiration P and L USD notes 16.00 dollar plus $180. All options expiry worthless. You keep full credit. $17.50 plus $180. $180 at the short price, still full credit. $18.40. 0 break even. Underlining at expiries. P&L USD notes approximately $22.50 minus $820. Long call becomes ITM net result negative 30.00 $1,570. Example for larger loss as price rises. Illustrate $50.00 $3,570. Illustration of how losses escalate. No hard cap. Values are exact for the premiums we assumed. All P&L values are for the whole position, not per share. Risk management and practical notes. Must reads unlimited upside risk because you are net short one call, two shorts, one long. The position has uncapped upside exposures. You very conservative position sizing. Assignment risk. Early assignment of short calls is possible. American options, especially if dividend or deep ITM maintain spare buying power, or be ready to buy back legs. Margin and broker rules. Margin requirement varies by broker. Before trading, check margin needed to carry a net short call exposure. This is the typically the bigger real cost than credit received. Liquidity and fills. Ratio spreads can be tricky to fill at the desired net credits. Use multi-leg combo order or place limit orders on each leg simultaneously. Alternatives to limit risk. If you want a capped loss version, I use a 2.2 2:2 sell 2 buy 2, or a ratio back spread variant buy more long than shorts, or choose closer long sides, but those changes the premium profit and may remove net credit. Exit rules. Common rules. Take partially profit at 30 to 50% of maximum profit. Here that would be 54 to $90. Close or roll if loss reaches 50 to 100% of margin, or if underlining moves strongly past K1. Pick voiceover specific to this mark. Trade short. Trade example. FRAMI at $16 as well 217.50 calls, and by 122.50 calls. 45 days out. We correct a net credit of $180 upfront. That is our maximum immediate profit if FRMI stays at or below $17.50. Break even expiry is 18.40. Above that, the trade starts to lose money. Important because we are net short one call. The upside is not capped. Losses rise as FRMI moves for above the long size. Size this trade small, monitor near expiration, and set a clear stop or roll plan to limit large losses. Short checklist before you trade. This is the important practical. Check options strain, liquidity, and near-term open interest. Confirm margin and assignment rules with your broker. Confirm dividend dates, ex-dividend, if equity options, assignment risk. Use limit multi-leg orders. Avoid legging into ratio legs. Do the math on worst case loss per share and overall. Consider smaller size until you have executed a few paper trades. Please like, subscribe, and comment. Any comment. And another 2 minutes 30-second video is there. That is your art touch video. Please see that video.
The short ratio call spread strategy is a specialized approach in options trading, particularly relevant for those engaging in the cryptocurrency market in the USA. This method involves selling a call option at a lower strike price while buying additional call options at a higher strike price. To begin, select a cryptocurrency you believe will experience moderate price appreciation. Next, choose an expiration date that matches your market outlook, then determine the appropriate strike prices for both selling and buying call options. Establish your position by executing these trades and closely monitor the asset's price movements to manage risk effectively. The goal is to achieve a minimum profit if the price rises moderately, with losses limited to the net premium paid. Careful planning and ongoing oversight are essential to maximize the benefits of this strategy while keeping potential risks in check. Let's take a closer look at 3 promising growth stocks currently trading under $20. Enovix Corp specializes in advanced lithium battery technology and is making strategic moves, such as relocating manufacturing to Malaysia, which is expected to yield significant cost savings. With a recent sales report of $3.8 million and a consensus price target of $21.33, Enovix presents strong upside potential. Innodata Inc. focuses on data engineering and artificial intelligence, boasting a 66% year-over-year revenue increase and expanded credit facilities to support further growth. Analysts anticipate Innodata shares could rise by more than 78%. Vey Alco Energy Inc. operates in oil and natural gas exploration, maintaining a low PEG ratio and outperforming earnings expectations, with analysts projecting over 39% upside. Each of these companies demonstrates unique strengths and growth trajectories, making them noteworthy considerations for investors seeking value opportunities.
Please subscribe. Let's grow your channel, YouTube channel, that is. Only its creators, YouTube creators. Steady stock profit. Low risk stock option. Smart stock size. Triple stock growth. Grow your wealth. Seven days to profit, dollar profit. and last one is mine, that is, you know.
Yes.
Positive or negative comment, any comment I will receive. Thanks my friend, I will see tomorrow video. Thanks once again friends.